Insider dealing is governed by Part 5 of the Criminal Justice Act 1993 and represents one of the most serious offenses affecting securities markets. It arises where an individual possesses inside information and improperly exploits that information to obtain a financial advantage before it becomes publicly available. The prohibition seeks to preserve confidence in financial markets by ensuring that all investors trade on an equal informational basis. An individual commits insider dealing where they deal in price-affected securities, encourage another person to trade, or disclose inside information other than in the proper performance of professional duties. A person possesses information as an insider where they know that it is inside information or where it has been obtained from an inside source, such as employment, directorship, or share ownership in the relevant company. Inside information must relate to particular securities, be specific or precise, remain unpublished, and be likely to have a significant effect on market price if made public. The legislation recognizes several statutory defenses, including situations where the accused reasonably believed that the information had already been widely disclosed or where the transaction would have occurred regardless of possession of the information. Conviction may result in imprisonment and financial penalties, while any director involved may also be liable to account for profits earned in breach of fiduciary duties. Although transactions remain legally effective, criminal sanctions reinforce the principle that confidential corporate information must never be exploited for personal gain. Market abuse. The broader concept of market abuse is regulated under the Financial Services and Markets Act 2000 and extends beyond traditional insider dealing. Its objective is to maintain fair, orderly, and transparent financial markets by prohibiting conduct that undermines investor confidence or distorts market pricing mechanisms. The legislation identifies 7 categories of market abuse. These include insider dealing, improper disclosure of inside information, misuse of information, manipulating transactions, manipulating devices, dissemination of misleading information, and distortion or misleading behavior that creates false or deceptive impressions regarding securities or market activity. These provisions recognize that market manipulation may occur through a wide variety of sophisticated techniques extending beyond direct trading on confidential information. Unlike insider dealing, which is principally a criminal offense, market abuse often attracts regulatory sanctions, including unlimited financial penalties and public reprimands imposed by the financial regulator. The availability of civil enforcement enables regulators to respond effectively to misconduct that damages market integrity, even where criminal prosecution may be inappropriate. Consequently, listed companies and financial institutions are expected to implement comprehensive compliance systems to monitor trading activity, protect confidential information, and ensure regulatory reporting obligations are fulfilled. Money laundering. Money laundering refers to the process by which the proceeds of criminal activity are converted into assets that appear to originate from legitimate sources. The principal legislation is the Proceeds of Crime Act 2002, which establishes comprehensive criminal offenses and reporting obligations designed to prevent criminals from integrating illicit funds into the lawful economy. Money laundering traditionally occurs through 3 distinct phases. The first is placement, whereby criminal proceeds are introduced into apparently legitimate businesses or financial systems. The second phase, layering, involves transferring funds between businesses, jurisdictions, or financial institutions to disguise their original source. The final phase, integration, occurs when the funds re-enter the legitimate economy appearing to derive from lawful commercial activity, thereby concealing their criminal origin. The legislation creates several criminal offenses. The primary offense involves concealing, disguising, or transferring criminal property. A separate offense arises from failure to report suspicions of money laundering, particularly for professionals such as accountants and solicitors who know or reasonably suspect that another person is engaged in laundering criminal proceeds. The offense of tipping off prohibits disclosure likely to prejudice an official investigation once suspicious activity has been identified. These reporting obligations place significant responsibilities upon professionals operating within regulated sectors. The penalties are severe, reflecting the importance of combating organized crime and financial misconduct. Money laundering may attract up to 14 years imprisonment, while failure to report and tipping off offenses also carry substantial custodial sentences and financial penalties. Accordingly, businesses must establish effective anti-money laundering controls, customer due diligence procedures, and internal reporting mechanisms to ensure compliance with statutory obligations. Bribery. The Bribery Act 2010 establishes a comprehensive framework prohibiting corruption in both domestic and international business transactions. Bribery involves offering, giving, receiving, requesting, or soliciting anything of value in order to improperly influence the performance of a public or private duty. The legislation reflects the principle that commercial decisions should be based on merit rather than improper financial inducements. The Act creates several offenses, including bribing another person, accepting a bribe, bribing a foreign public official to obtain business advantages, and the important corporate offense of failing to prevent bribery committed on behalf of a commercial organization. This corporate offense imposes liability even where senior management had no direct involvement, thereby encouraging organizations to maintain robust compliance systems and ethical business practices. The principal statutory defense available to a commercial organization is to demonstrate that it had adequate procedures in place to prevent bribery. Such procedures typically include risk assessments, employee training, due diligence on business partners, whistleblowing mechanisms, and effective internal controls. Individual offenders face maximum imprisonment of 10 years, while companies may incur unlimited financial penalties.